All right. So to get to the current debt market update, the question that Shelley put out there was, will we ever see 3% interest rates again? That's a big question. Um, and I don't really have an exact answer to that other than, 3% interest rates are not normal. What we had, over the last several years with these extremely low interest rates is not the norm. Um, you know, I'm not saying that we couldn't get to that point again, but it's not normal, and I don't expect it to happen anytime soon. A lot of the analysts and a lot of the experts are saying that we're going to kind of hang out in this, 5 to 8% range for several years. And we're going to bounce around from 6 to 7 to 8 and back to 6, and it's going to be kind of a fluid market. A lot of the analysts are saying. So we'll see. It's going to be fun to watch. Tune in every other week, and we'll talk about it and see where everything's at. But as far as right now, there's no signs saying, hey, we're going back to 3%. The thing that they've been talking about on Bloomberg TV is, how strong the jobs market is in the US right now. And that the Fed is very discouraged by how strong the jobs market is, because they don't want people to be able to, have all this extra money that then they can spend and raise inflation. They're trying to curb inflation. And, so if you listen to them and you can kind of listen through the big words and things they use, it's, hey, we want to take all your money away, your equity away, and we want you to have less savings. We want you to not work. We want all these things, and then assets will go down in value, and we can buy more of them. And that's kind of what you hear all the analysts saying on TV. But they use words like, curbing inflation and those types of words instead of those. But anyway, where are we at with the current rates? We have a rate sheet that we'll be talking about in a page or two from here, and we'll be going over the Freddie and Fannie rates. The Fed rate now since last week is 5.25 to 5.5. It's the highest federal funds rate in 22 years, I believe. SOFR has been kind of unchanged. It's the secured overnight financing rate, and that's the rate that the banks trade back and forth on. A lot of our lenders, they're borrowing money from the banks and from investment banks, in Manhattan and things. They're borrowing big chunks of money to then lend out on deals. These private lenders, a lot of them, that's where they get their money, is from Wall Street, and then they turn around and they're borrowing at 5 to 7%, and then they're putting on 2 or 3% above that. But those rates are usually based on SOFR. So when you see the SOFR rate, just know that that rate there is what a lot of bridge debt and things is based on. The 10-year Treasury, I changed it just a couple hours ago on this sheet. We were at 3.8 this time last week. We're about 20 basis points higher than that today. So when you're going after Freddie and Fannie debt, you're going to be about 20 basis points higher this week than you were last week. So, and as your 10-year Treasury goes up, the spreads are going to get bigger too. So your spreads are going to increase. So it might not be 20 basis points. It might end up being 30 or 35 basis points higher when you get to your final rate. So with the current market, the damage to the market is happening right now, but the problem has already occurred. Okay, the big problem in the market currently is the rates have jumped up at such a drastic increment in such a short amount of time. And that is, the hurricane per se, and when that hurricane came through, it tears everything up, right? but now we've got a couple years of rebuilding to do. So all these people that are in these loans that are, maybe they borrow at 8 million at 3%, and now that 8 million, when they have to refi out of this bridge debt, or when they when their loan comes due, the term on their loan comes due, and they go to an adjustable rate, that 3% loan for 8 million, to replace that loan, the only thing they can do is you're like 4.5 or 5%, or 4.5 or 5 million on a loan to replace that $8 million loan. Well, a lot of these apartment owners don't have 3 million sitting around to put into the loan to be able to refi. And so they're stuck trying to sell, for more than the property's worth at the current market. And therein lies the problem. And as more and more of this debt comes due, and these properties, the terms on these loans come due and they go to adjustable rates, there's going to be more and more and more problems for building owners in the current market. So that's what's going on, and it's going to be a slow process. It's not going to happen overnight. It's not going to happen just, in the next 6 months, more than likely. We're going to start seeing some little signs of it, but I think it's going to roll over into next year, and we're going to see, a lot of foreclosures. I've had quite a few deals brought to me that, these people are upside down in the property. They owe, 3, 4, sometimes 5, $10 million more on the property than what they can borrow to get out of the loan. And they just don't have that amount of cash to get out of it. So when that happens, you've got, equity investors, if they've borrowed 10 million to buy this property, you've got 5 million in equity investors, right? And now the property, maybe you can only borrow 7 or 8 million on it to refi. Those equity investors, the equity's gone. There's no more equity. So their 100,000 to 500,000 a piece, or $1 million a piece that went into the properties, now vanished just overnight. Thank Jerome Powell, whoever you want to thank for it, but that's what happened. And then now you have a bank that has $8 million in debt on this property. They might not get 8 million out of it when they go back to the market to try to sell it. So then now you having the banks, starting to hurt as well. So it's going to be a long process. It doesn't happen overnight. But what I can say right now, do not overpay for properties. Do not overpay for properties. Just because you have, assumable debt at 3%, that doesn't make that property more valuable than one that you're going to have to take new debt on. Because eventually that assumable debt, that term's going to run out. So there might be some value there in that assumable debt, but it's not full. It's not a full value of the price of the property. Don't get excited and FOMO and think you're going to miss out. Hold to your guns. Make sure that you're not overpaying for properties. I can't stress that enough. I'm in Grant Cardone's real estate club, and there was a guy on there today, their group on there today, and they were looking at a deal, and they're like, we think this is a good deal at 29 million. And Grant looked at the deal and went through the numbers with them, and he's like, you need to offer him 21 million. He was like, that's not a deal at 29 million. You're overpaying, by 33% or whatever it is there. There needs to be big discounts on these properties if you're purchasing now. I'm a lender. I'll lend you money on anything that we can get the financing done for, but just as a trusted advisor, I like to think of myself as, don't overpay. So what are my lenders saying and doing? Mark. Yeah, go ahead, Mark.
Yeah, I had a question about that.
Yeah.
As far as lending. So what size properties are these people purchasing that that are, paying the 20, let's say 29 million for, and how can you come back and offer 21? I know Grant, I've been in Grant's real estate club and classes too. Sorry, I'm not on camera. I'm driving,
Oh, you're good.
but, uh, what, I mean, just in doing underwriting myself, just kind of like the quick underwriting that I've learned from Grant, on a property and going, okay, this is what this is valued at. How do you then all of a sudden go, oh, it's not 29 million, it's 21 million, and offer that? How does, I'm just trying to make sense of that. If
Yeah.
that makes,
Yeah. Well, the way they was looking at it is, or the way he was looking at this one is their first year cash on cash for the investors was going to be like
uh-huh.
2.5 or 3%.
Mm,
And they're hoping, over the next 2 or 3 years that it's going to be, 7, 8, 9%, in a 5 or 10 year hold, and then they're going to make a bunch of money on a sale. Um, and the argument against, that is, we don't know what's going to happen in the next 5 years. I mean, this downturn in the market might take 5 years. You
yeah.
know, and then when you're looking in that way, and you're looking at getting a cash on cash of 2, 3, 4, even 5%, you can get that from a U.S. Treasury right now.
Okay.
I mean, the U.S. Treasury, you can get 4%. So why would you ever go into an equity position for 2%?
Yeah.
And that was
And
the
then,
argument against it. And then that's what you use when you're talking to your seller or your broker is, hey, look, my investors are only going to make this. The numbers work the same for any buyer. How are you ever going to sell the place at this price? And then you
okay.
turn around from there and you say, and you know, you're wanting to sell it for 29 million or 30 million or whatever it was. And then you're saying, but I can only get, 15 million in debt because of the way the market is right now. And so then you come to
Uh,
the how, because I'm having to raise so much equity, their portions of the percentage are going down. If I'm going back down and I'm instead of raising, 15 million in debt or in equity, I'm now raising 5 or 6 million. My cash on cash is going to go up to 6, 7, 8% the first year that way.
mm.
And
Now,
the numbers are the same for everybody. So
yeah, yeah. Now, in what ways have the loan terms changed than what they used to be? Because I know Grant talked about doing interest-only loans for the first 3 to 5 years on these, just so that you could take that principal that you would be getting and either reinvest it or do something else with it. So are those terms still out there, or is that completely
yep.
changed?
Yeah, we're actually we turned an application in this week to a borrower, or last Friday we turned an application into a borrower, and it's a small balance Fannie Mae loan, and our rate
Hmm.
6.3%, 10-year term, and it was 10 years of interest only.
Oh, wow.
And so I went back, and the borrower decided, hey, I don't, I'm going to own this property forever. I don't want 10 years of interest only. I want to pay some of the principal down. And we went back to Fannie, and Fannie said that we're going to jump the rate like 15 basis points if we go to P&I, because that's going to kill the DSCR because they're going to pay more.
Okay.
So, I mean, the market is still, Fannie and Freddie are wanting to give interest only because it helps the DSCR. They don't underwrite
Hmm.
the DSCR to the interest only payments. They always write the DSCR to a P&I, but they're
Yeah.
going to, the actual the actual DSCR will be better if you have P&I, or if you have interest only payments. So
Yeah. And to kind of reach that 1.25, what is it? 125%.
yeah, I mean, a lot of deals right now we're needing to get to the 1.3 to 1.4.
Now, um, is it even smart? Because it seems like in this economy and what's going on, that you would want to do something that is making sure that you're not going to lose money on whatever you invest in. And, I would want to make sure that DSCRs is not too high, but at a high enough rate that if things do slow down, you can still cash flow or at least break even. Is that
Oh,
a
yeah.
good?
Yeah.
Uh,
Always
cool.
prepare for the worst.
Cool.
Yeah.
Well, man, I appreciate this. I won't take up too much of your
Oh,
time.
you're good, man. Thanks for being here.
Yeah, my pleasure.
Yeah. All right. So what are the lenders saying and doing? Lenders, lenders are still looking at deals. So that's the good of it. When lenders stop looking at deals is when we need to worry. So Fannie and Freddie have a lot of money there to lend still. I think a lot of the banks are starting to, they're getting squeezed a little bit. But as far as private lenders, they're still looking at deals. They're being more selective. We have some lenders that do a lot of fix and flip lending. Single family 1 to 4, units that they're, lending a lot of, smaller deals, and they got into the multifamily market for the smaller balance multifamily just a couple years back. Some of those have dropped out of the multifamily market just because, hey, we don't know this market as well. We're going to drop out just and stay with what we really know. So kind of some of that stuff is going, but lenders are still looking deals, so that's good. But they are being more selective. Jeff, how's it going?
Pretty good. I've got a quick question for you. The federal government got its credit rating lowered today. And I'm just curious as to what you think the impact is going to be on us borrowing money, because if we're borrowing money and the government's borrowing money at a higher rate, what could happen to us? I'm thinking we're gonna be headed for a different kind of a wreck that we're not expecting or not anticipating because we're not paying attention to the news of the day.
Yeah. That could definitely trickle down to the banks. It makes sense that it would. And that's all the more reason to be careful as you're writing and looking at deals and writing offers. So yeah, it could really trickle down, and could mean that the banks and credit unions and the lenders and everybody they are having to pay a higher interest rate to get money. And then you have the fear of quantitative tightening, where they start allowing them to lend less on the amounts of money that they have and the amount of reserves they have. So there's a lot of fear, as far as those types of things happening. I haven't heard a lot of people talking about it yet, as far as what's going to happen there, but I think there, a lot of people just don't know what to say about it.
Well, I think the news probably takes 3 or 4 days to settle in where most people, hit the circles and where they walk around. The thing is, if you don't pay attention to some of the news that comes out every day, it can put you behind the power curve if you wait a week on something. It could change an entire focus on a deal. And the thing is you got a lot of sellers that are unrealistic. I don't know if anybody else has run into this problem, but every deal that I've seen the last couple of months, I've had cap rates that are nowhere near where they should really be, because the cap rate's a direct reflection of what the interest rates are. They're on different sides of the teeter-totter, and people are thinking, oh no, it's a 3 cap, it's a 4 cap, and I'm saying no, it's a 6 or 7 cap. You have to be above or at or above the interest rate. You really need a 2-point difference to be profitable, because if you're doing the same interest rate as a cap rate, you're headed for a wreck.
Yeah, you're breaking even. And you can't break even on a property because there's always going to be problems.
Who's going to pay all your investors?
Yeah. Yep. And Grant has talked about that on some of our weekly Zooms that we have with the real estate club. He's talked about, people bring deals and they're trying to buy deals that are, 30 and 40-year-old buildings, and maybe in the Midwest, and they're trying to buy for a 6 and 7 cap. And he's showing us properties that he's buying that are A-class properties that he's getting for a 6 cap.
Yeah.
And he said, if you're going to invest in a 6 cap property,
get one.
Said, why not invest in a new one with me, instead of buying these old ones, So some of these older properties, we're in the Cincinnati area, if I'm buying something in this area, it's going to be an 8 cap or plus, it's not going to be a 6 cap deal. So, but, all right. Well, thanks for being here, Jeff. So here is, the small balance Fannie and Freddie sheet that we're working off of right now. Take a screenshot or a picture of that. I said that we just turned a term sheet in. It was a 10-year interest only for 6.33%. And it was a Fannie loan, but we were at 6.33. We had some, lower, some affordable housing involved and things like that, which helped our rate to be really good. So